Hi, my name's Eric, and I'll be reading you selections from Barron's Financial Magazine for September 30th of 2024. The cover story, 21 stocks to play a magical moment in healthcare. The sector is bouncing back. Shares of many pharmaceutical and biotech firms still look alluringly cheap, our Healthcare Roundtable panelists say. This is reported by Lauren S. Rublin. Investors have circled back to healthcare stocks this year, and they're likely to stick around. If they came for the science, blockbuster obesity drugs, advances in cancer treatments, novel cell therapies, they'll stay for the macro story, specifically a slowing economy and falling interest rates, which tend to favor the sector. We're in a wonderful, magical moment in science and investing, said Eli Kasdan, Chief Investment Officer and founder of Kasdan Capital and a member of Barron's 2024 Healthcare Roundtable. The sector's lackluster performance in 2022 and 23 and a brutal bear market in biotech have left the shares of many pharmaceutical, biotech, and life sciences companies alarmingly and alluringly cheap. At the same time, advances in diagnostics, drug development, and delivery are turning once fatal diseases into chronic conditions and offering fresh hope to millions of patients and their clinicians. While the regulatory environment is cause for some concern due in part to the introduction of Medicare drug price negotiations, regulators are likely to look less skeptically on mergers and acquisitions in the next administration, no matter the party in power. Plus, lower interest rates will make financing more affordable, especially for young companies that desperately need funding. This year's roundtable was held on September 12th on Zoom and featured 4 healthcare investment experts: Andy Acker, portfolio manager of the healthcare and biotech strategies at Janus Henderson Investors; Kasdan, a veteran biotech investor; Dana Graybosch, a senior managing director and biopharma analyst at Leerink Partners; and Jared Holz, healthcare equity strategist at Mizuho. In addition to sharing their big picture views, our panelists made the case for 21 healthcare companies of all stripes and their shares. An edited version of the roundtable discussion follows. The question from Barrons: healthcare stocks are on the rise after several years of poor performance. What's drawing investors back to the sector? And more importantly, what's the outlook? From Andy Acker. Despite expectations for a recession back in 2022, the economy has stayed stronger for longer. That hurt the healthcare sector, which is viewed as more defensive. Also, the industry has suffered a COVID-19 hangover. Sales growth accelerated during the pandemic due to demand for new therapeutics, vaccines, treatments, and diagnostics, but that sales burst has come off in the past couple of years. Recently, however, the economy has shown signs of starting to slow. Interest rates are expected to come down potentially this month. The Federal Reserve cut interest rates by 0.5 percentage point on September 18th. Lower rates could be a boon to the sector, and especially biotech companies, which have long-duration assets and in many cases are years away from meaningful revenue and cash flow. Eli Kasdan's response: rising interest rates in 2022 and 23 really squeezed small companies. Cost of capital anxiety has made biotech a difficult place to invest. With the loosening of that interest rate belt, biotech companies potentially will have an easier time getting funding, and there is some strong data indicating that biotech has worked well in recessions. Many companies have no earnings to revise downward. The industry isn't cyclical in the typical sense. As people become more comfortable with inflation falling and monetary policy loosening, biotech stocks could pick up again. Jared Holtz's response: the healthcare sector is dominated by 2 categories: large cap pharma and managed care. Both are facing political and regulatory crosscurrents, and both need to outperform to create a successful trajectory for the broader healthcare space. I'm skeptical that healthcare will outperform in the near term unless both of those categories do well concurrently. As for biotech, the stocks haven't done anything on a net basis in more than a decade. This has been a flat sector with the exception of the pandemic. Unfortunately, a lot of investors looking at the space have been tricked into thinking that either innovation, drug approvals, or mergers and acquisitions would lead to better overall performance. Empirically, none of those are drivers for better performance. Unfortunately, if you're an investor in biotech, you have to cross your fingers that macro trends, whether lower rates or something else, will help you make money. The question: you might get some pushback on that idea from this panel, but first let's hear from Dana. Dana Graybosch's response. The Inflation Reduction Act was passed just as the COVID pandemic was ebbing, and it sparked a lot of nervousness about drug price trends, namely how to think about the tail revenue in the later years of patent protection of some important products. We have now had the first round of Medicare drug price negotiation as mandated by the IRA, and it perhaps wasn't as severe as people feared. That could be positive for some of the larger drug stocks. While the environment for biotech might be challenging overall, individual companies could have opportunities, and the science keeps investors engaged. I see opportunities in companies that have good fundamental data and have been de-risking. Acker says, I agree with Dana. We should remember that we're investing in the least efficient sector of the market. Every year for the past 10 years, the difference between the winners and losers in the healthcare sector have been more than 300%. In biotech, the divergence has been even more extreme. The healthcare sector, more than any other, lends itself to active management. Owning the right stocks and avoiding the worst ones can add tremendous value. From Barrons. Moderna recently reduced its research and development spending and said it was pausing development of certain products. Will an announcement like that weigh on sentiment across the pharma industry? Kasdan's response. The company's lead mRNA franchise doesn't have the same growth dynamic as in the past. Moderna needs to focus. For investors, Moderna probably is more interesting, not less interesting, as a result of this decision. Periods of contraction are painful for investors' wallets, but healthy for the industry. Companies that come through the rationalization process are better businesses and therefore better investments. From Barrons, speaking of better investments, GLP-1 obesity treatments are the talk of the healthcare market. The shortage in Eli Lilly GLP-1 treatments seems to be ending. Sales of Novo Nordisk's Ozempic and Wegovy are climbing sharply, and additional data have come out about other indications for the drugs. Have your expectations about the size of the market for these products changed? From Acker. We've owned Eli Lilly and Novo Nordisk for the past 10 years in our healthcare strategy. Did we know GLP-1s would be this big? No. These products started as diabetes drugs. We're now recognizing they're highly effective as treatments for obesity, which may be the biggest market opportunity we've ever seen in healthcare. More than 100 million people in the U.S. and 800 million globally are overweight or obese. As of this year's second quarter, the obesity treatment market was dominated by two companies, Lilly and Novo, and their stock performance reflects that. On an annualized basis, GLP-1 sales are more than $50 billion and still growing by 50% a year. Global penetration is still in the low single digits. Lilly and Novo have competitive advantages. Manufacturing these products is extremely difficult and expensive. A plant costs more than $1.7 billion to build and requires 3 or 4 years of lead time. There are a limited number of manufacturers of the equipment needed to build these plants. Lilly and Novo are spending combined about $10 billion this year in capital expenditure. It'll be difficult even for makers of biosimilar treatments to compete as Lilly and Novo's patents expire. There'll be some competition, including companies we're invested in and excited about, but the competition is still a few years out. From Holtz. This is the most complex sector in the market and the easiest concept to understand. Obesity will remain number one or close to number one as a category of interest for the buy and sell side going into next year. So many therapeutics are given to patients too late. We're finally seeing a drug that's a preventative medicine for a whole host of underlying conditions. That is an underappreciated element of the bullish thesis. From Barrons. Eli, are there particular biotech companies that you regard as potential longer-term competitors to Lilly and Novo, or that could be compelling takeover targets for big pharma in the GLP-1 space? From Kasdan. While technological leadership seems to favor Lilly and Novo, what's the margin of their leadership as competitors enter this space? It seems the threat is pricing pressure from competition more than market share grabs. The small molecule element of this market is competitive globally. Lilly's in the lead with phase 3 data coming next year for its small molecule, and that data will help establish the potential for oral agents in the obesity market broadly. We have been longtime shareholders in Structure Therapeutics, first investing in 2021 when it was still private. Structure is next in line with a first-generation pill form of GLP-1 and a pipeline of next-generation oral solutions. We think Structure is a prime partner for any pharma that wants to build a leading franchise in this space. From Barrons. Dana, could the high price of GLP-1 medicines affect the conversation around drug pricing, spurring a new effort at drug price reform beyond the IRA? From Graybosch. Yes. Some states have said that the cost of these medications is having an impact on their overall budget. The cost of insulin has been at the center of conversation about drug price negotiation. The cost of GLP-1s could have a bigger and broader impact. It'll be part of the discussion in the next administration, no matter who's in charge. Any further thought about GLP-1s? From Kasdan. Well, there is some concern about muscle wasting in patients on these drugs. You couldn't find a muscle-building therapeutic strategy in earnest in the past 5 years, but now that the concern has arisen, science is pivoting to this derivative issue. The focus on GLP-1s has opened up a whole new pathway in muscle and musculoskeletal opportunities. From Barrons. You seem to have anticipated the next question. What are the most promising treatments beyond the obesity space? From Kasdan. Well, the ability to target the genetic drivers of cancer, typically referred to as precision oncology, has had a transformative impact on this disease. In coming years, the diversity of these targeted therapies will only grow. But making a big business from niche indications is a hard task. We're focused on companies like Revolution Medicines, which have the biggest market potential and the capital to stay ahead of the pack. RAS mutations are the clear culprit in 30% of cancers, including more than 90% of pancreatic and 30% of lung cancers. Revolution's drug, RMC-6236, has shown promising efficacy and safety in late-line pancreatic cancer patients. While the science has gotten better, however, investing in the oncology space has gotten harder. The scope of drug trials and the range of therapies and modalities has increased the complexity for investors. We're also excited about the impact that a number of genetic medicines in our portfolio are having in rare genetic disorders, from musculoskeletal to neurological diseases. The patient populations are generally small, but if you develop a drug with a big impact, you have pricing power. We're investing in technologies such as siRNA, gene therapy, CRISPR-based gene editing, and cell therapies. In time, we should expect these technologies to transition to bigger, more chronic disorders in cardiovascular and neurodegenerative diseases, to name a few. From Graybosch. We're excited about the use of cell therapy in oncology. The science is spectacular. Cells are removed from a patient's body, re-engineered in a way that fights disease and infused back into the body. And we're seeing CAR-T therapies used effectively to treat multiple myelomas and lymphomas, and there are hints of its efficacy in treating solid tumors and autoimmune diseases such as severe refractory lupus. From Barrons. How can investors navigate the complexity of drug discovery and development? Gray Bosch's response. Cell therapies are delivered via a specialized network of transplant centers. In the U.S., we're bumping up against the capacity of that network, which hasn't been developing as rapidly as the science. In oncology, and even in autoimmune disease treatments, we are running into a systems problem. It's hard enough to pick the right winners from a science perspective, but thinking about which companies can succeed commercially is also important. Gilead Sciences' Kite division has been relatively successful in dealing with the more fundamental issues of manufacturing and delivery. You need to think holistically as an investor and look for companies that have invested not only in the science, but also the delivery. From Kasdan, they need to have the right leadership too. The value of seasoned leaders is often overlooked in our space. It isn't just the CEO or chief science officer, but also the chief financial officer and the chief medical officer, really the team. As an investor, you can't just follow the hot science. You have to think about it in the context of the business. Acker's response, our framework for thinking about healthcare investing is something we call the 90-90 rule. From a clinical perspective, 90% of the drugs that begin human clinical testing will never make it all the way to market. The second part of the 90-90 rule is the commercial risk of developing a successful therapy. In our experience, Wall Street's consensus sales estimates for new product launches have been wrong about 90% of the time. Those estimates can be either too high, in which case you want to avoid the stock, or too low. Navigating both parts of the 90-90 rule is tricky for most investors. Kasdan said, one way to improve on the clinical risk is to diversify. We like companies with multiple shots on goal. As investors, we want the optionality that a diversified company platform can provide. The rub is that it costs a lot of money to sustain a platform. On the commercial side, there's an old and frustratingly accurate maxim used in biotech investing: short the launch. Estimates of a product's potential are almost always too optimistic. But if a company can survive an early disappointment, it might become interesting from a valuation perspective. The most profitable biotech investments are found in companies compounding sales post-launch. From Barrons, a huge wave of biotech companies came public in 2021. Then the window for initial public offerings shut firmly in 2022, although a few deals were priced in 2023 and 24. Jared, is the IPO window reopening in a more serious way? And if so, how should investors think about new issues, given the mixed quality of companies that came public in 2021? From Holtz, the window is reopening slightly. There's a bit more receptivity toward new issuance in biotech, particularly given that the broader biotech index, although lackluster in performance, has been more stable lately than over the past 3 years. A big factor in the underperformance of biotech stocks in the past 5 to 10 years was the explosion of IPOs in the period from 2019 through 2021. It created an industry vertical that became much more difficult to analyze, and in an industry with very few winners, as we've discussed. The past 3 years have been something of a cleansing period for the biotech sector. There have been some acquisitions and some consolidations. The denominator, the number of public companies, has been on the decline, which is helpful. It allows for better, more detailed research. From Kasdan, hundreds of companies came public over a 6 to 7 year period. Most were preclinical, which is a feature of the biotech market, not a flaw. The capital markets kicked a lot of those companies into microcap land. More than 70% of companies in the life sciences sector are trading below $1 billion market cap. That's up from 57% in the first quarter of 2021. More than half of that market cap is cash, by the way. This creates a greatly improved landscape for investors looking to pick winners. History suggests that if you poke around among companies in the $750 million to $3 billion market cap range and pick those with good balance sheets and management teams, you can make a lot of money. The high volume of biotech IPOs created a pig in a python issue. The capital markets have largely corrected for it. From Barrons, Let's revisit the topic of drug price negotiation. What will this mean for the industry in the next few years? From Graybosch. Because the first round of price caps wasn't as bad as feared, that lifted some of the pressure on pharma companies and stocks. In the oncology market, on which I focus, the glass is half empty and half full. Medicare negotiated the largest price reduction for ibrutinib. That's a small molecule treatment for blood cancers, but it had the smallest discount, an estimated rebate of only 10%, prior to the price negotiations. Some people have modeled price reductions that would result in almost no revenue for ibrutinib, but the downward curve in price reductions is softer than worst-case expectations. There are still some shoes to drop, particularly in oncology, and some uncertainty about how subcutaneous formulations will be treated. We expect guidance on that next year. The most successful approach to reformulate an infused biologic drug to a subcutaneous formulation is to mix the biologic with another enzyme called hyaluronidase. Because hyaluronidase is a biologic itself, these new formulations are regulated by the FDA under a new biologics license application, or what's called a BLA process. Under the IRA, combinations with two active moieties, which are called parts, are considered separate drugs relative to either moiety for price negotiation. A strict interpretation of the IRA should mean that each of these drugs would be split into two, the infused version and the subcutaneous version, with the IRA price imposed on just the former, as the subcutaneous versions in all cases launched many years later. The uncertainty comes from our understanding that this interpretation doesn't follow the spirit of the law, as though hyaluronidase is an active moiety, whereas it merely enables the other drug. Will the Centers for Medicare and Medicaid Services really allow about 40% of these major drugs, which have been converted to the subcutaneous formulation, to be exempt from the IRA price? We expect more specific guidance on the question next year. From Holtz. In some respects, pharma and biotech companies got lucky with the first 10 drugs targeted for price negotiation. Many of these drugs will face generic competition in the next 5 years anyway, so the overall net financial impact will be fairly small. Big picture, drug price negotiation is going to be a perpetual issue for the pharma industry and a negative one. That said, large cap pharma companies already are making pragmatic moves to adjust. We saw that with Moderna's decision to scale back its vaccine program. It's taking steps to address what will be a difficult 5 to 10 year period as more drugs are added to the negotiated price list. Price negotiation is forcing large drug companies to make a lot of strategic decisions. Acker said, starting next year, the IRA will limit Medicare patients' out-of-pocket costs to no more than $2,000 per patient per year. That will improve access for patients and lead to higher volumes for the drug industry, an often underappreciated aspect of the legislation. It will also help to reduce negative perceptions of the pharma industry. Barrons says, with that, let's move on to your favorite stocks, Dana. Which companies and stocks excite you today? From Graybosch. BioNTech plays into a lot of the themes we've discussed. The company made a lot of money from sales of the Pfizer-BioNTech COVID vaccine and is now spending that cash. In some ways, mRNA infectious disease vaccines were a side project for BioNTech, which is really an oncology company with multiple modalities. It develops mRNA vaccines for cancer, bispecific biologics, antibody drug conjugates, cell therapeutics, and more. But I'll come back to that. BioNTech fell on Moderna's news and trades in sympathy with Moderna. But it shouldn't. The company has more than 18 billion euros. That's like $20 billion of cash and equivalents, and it's spending in a very targeted way. It's buying products in immuno-oncology. It's acquired things cheaply, mostly in China. It's building an interesting portfolio. Barrons asks, give us an example. Graybosch says, BioNTech licensed a molecule developed in China called BNT 327 PM 8002. It's a bispecific antibody. That means the two halves of the antibody differ, allowing them to bind to different targets. It's similar to a molecule that Summit Therapeutics licensed from China that recently outperformed Merck's Keytruda in a phase 3 trial for treatment of lung cancer. The hypothesis, though uncertain, is that these bispecifics could replace the current checkpoint inhibitors, most notably Keytruda, that are the backbone of oncology treatments. BioNTech is sitting on an interesting asset that it has licensed quite cheaply and has a portfolio of other promising assets. Together, they could transform the company in the medium to longer term. BioNTech isn't without risk. It's a small company undergoing a major transition. It is scientist-led, and it's brought up a lot of interesting science. Can it assemble a program focused on the assets with the greatest potential and deliver? Well, that's the question, but it's worth looking at. What else do you like? Graybosch said, I'm a scientist at heart. CAR-T, or CAR-T, cell therapy is really interesting, although there's been well-deserved pessimism about the technology recently because of some of the challenges. RCellX, a clinical stage biotech, is working on BMCA, that's B-cell maturation antigen, CAR-T treatment for multiple myeloma. This CAR-T is jointly owned by RCellX and Kite. It looks to have the efficacy profile of Johnson & Johnson's and Legend Biotech's Carvykti and the safety profile of Bristol Myers Squibb's and 270 Bio's Abecma, two leading products in the field. We will get data potentially confirming that later this year. RCellX came public during the dark days of 2022 and has done well, despite the timing of its IPO and the challenges of CAR-T. There's been a rush into autoimmune disease by numerous companies with cell therapies and CD3 T-cell engagers, which is a related approach, following academic data from Germany and China indicating that CAR-T therapy could transform outcomes for severely autoimmune patients. How do you pick a winner? I'm excited about RCellX and the allogenic NK, the natural killer, cell therapy companies, Fate Therapeutics, Nkarta, Century Therapeutics, and Artiva Biotherapeutics, which came public recently, are some names to consider. Eli, what's on your radar? Kasdan says, we invest across the healthcare ecosystem, from research tools and services to life sciences, diagnostics, and therapeutics. A good way to play the growth of cell therapy is to invest in the suppliers levered to the critical consumable components of the product. One of our core holdings, BioLife Solutions, is directly levered to the growth of cell therapy with an 80% market share in cryopreservation, or the freezing and defrosting of cells. Once a cell product is approved by the Food and Drug Administration using BioLife's product, it becomes difficult and costly for the competitions and customers to replace it. BioLife was a consolidator for a while, and it's now deconsolidating to focus on the higher margin part of its business. The company has shed some lower margin, high CapEx businesses. Nearly 100% recurring revenue, pricing power, robust margins, and an important market niche make BioLife an exciting long-term compounder and a target for larger industry consolidators. The life sciences tools industry has $150 billion to $160 billion in annual revenue, 75% of it recurring, and $700 to $800 billion in market capitalization. It services everything from academic research to biopharma, diagnostics, and industrial research. Life sciences tools companies has been some of the best performers in the past 20 years. They have high gross profit margins and a good operating environment. Illumina was a longtime leader in this space, led by one of the best management teams in life sciences and powered by the best transaction in the industry's history. Illumina enjoyed about 12 years of 35% annual revenue growth. operating margins that peaked at more than 30%, and a market cap that exploded by nearly 3,000%. Barrons says, and then Kasdan says, the same company, under less capable management, made one of the worst transactions in the industry's history, costing Illumina in aggregate nearly $10 billion in cash and driving the stock down 82%. Operating margins fell to an industry low of 2%. We're now on our third administration and see an opportunity to win three ways. With new operating discipline, normalized operating profit margins could return closer to 30%, enabling earnings per share growth nearly twice that of peers. Next, while the newest generation of Illumina's sequencing technology overshot the demand curve, time will see the market work through excess supply and growth accelerate to 6 to 9% a year. Finally, DNA sequencing as a technology is early in its adoption as an omics detection platform. We see tremendous growth in clinical diagnostics and underappreciated long-term growth in academic research. The total addressable market is enormous, and if a team executes, it could drive big returns for shareholders. Shares are trading today at a 20 to 25% discount to peers on the basis of price to free cash flow. Barron says, well, Illumina has been a controversial story and stock. Kasdan's response, well, that's the fun part of investing. Sometimes the controversy lingers longer than the reality would merit. If you can part the clouds and see the sun coming through, you can have the opportunity to make money. Moving on, the diagnostics industry has come of age with several multi-billion-dollar market cap companies with high double-digit growth rates on the cusp of profitability. In the next decade, these businesses will continue to grow rapidly regardless of economic conditions. In diagnostics, we like GeneDx Holdings in the rare disease space and Exact Sciences in cancer. Both are profitable or will turn so in the coming quarters, and each has a strong management team. GeneDx holds a dominant position in whole exome genome testing for rare disease, a market less than 15% penetrated. We see a long runway for 20% plus annual growth and gross margins approaching 70%, all at a discount multiple versus peers. Exact built the market for non-invasive colorectal cancer screening and will leverage this position to launch several new products over the next 1 to 3 years through its existing commercial infrastructure. Earnings before interest, taxes, depreciation, and amortization have gone from negative in 22 to more than 15% of sales today. We see a path to 25 to 30% of sales by 2027. The non-therapeutic space holds a lot of opportunity and fits a growth investor's model much more so than the event-driven quote-unquote therapeutic segment does. In therapeutics, Sarepta Therapeutics is another controversial stock. It has a newly approved gene therapy for Duchenne's muscular dystrophy, where it has already built a near blockbuster business. Given the substantial remaining unmet need and the degenerative nature of the disease, we expect uptake for this one-time therapy to be robust, particularly in the next few years. Sarepta is in a unique position for a biotech, with profitability achieved and strong cash flow in sight. But the company trades at the low end of pharma multiples at about 10.8 times 2025 estimated earnings and 3.7 times expected revenue. The discount is unwarranted. As revenue and profits grow, the stock will start to move. Sarepta has one of the best commercial biotech CEOs with a good strategic sense. In coming years, the company will have billions in profits to redeploy and opportunities to grow organically and inorganically beyond the current pipeline. Andy, the floor is yours, says Barrons. Acker says, first, I second Eli's view on Sarepta. We're big fans of the company. Duchenne muscular dystrophy affects more than 10,000 children. Sarepta got expanded labeling just a few months ago that essentially allows it to sell its Duchenne drug, Elevidys, for treatment of all patients. Based on our research, the feedback has been positive, so we expect rapid uptake for the therapy. We focus on products that we consider medical breakthroughs that can change the practice of medicine and that have underappreciated clinical and/or commercial potential, ideally both. I'll share a few ideas, all of which we own in our healthcare and biotech strategies. We've owned some for many years, and in many cases, we're one of the largest shareholders of the company. We have owned argenx since 2017. The company has a breakthrough therapy called Vyvgart that can knock out all of the autoantibodies in your body. When your immune system goes haywire, your antibodies attack your own tissue, and that causes many different diseases. The drug's now annualizing sales at almost $2 billion a year, and in the second quarter, sales grew by 78% year over year. Vyvgart is sold for just a couple of indications, but argenx is developing it for up to 15 indications. We think it could be a potential Humira-like opportunity in that a single drug could address multiple autoimmune indications. Humira is made by AbbVie. argenx has about a $30 billion market cap and several billion dollars of cash. The stock has been a strong performer, up about 40% year to date, but we're a long-term fan. The company has grown with great management and makes an amazing medicine, and that usually works out well for investors. Barrons asks, what else are you betting on? Acker says, Amgen is sometimes viewed as an older biotech company, but it's been quite innovative. We're excited about a number of products in the pipeline. Amgen could become number 3 in the obesity market. We will see phase 2 data by year-end on the company's drug Maritide. Amgen has already seen early signals from that study that got the company excited enough to move forward into a full phase 3 program. There could be several advantages to Maritide. Most obesity therapies today are weekly injectables. This drug could be given once a month or even less frequently, potentially every 2 to 3 months. And that's important because patients need to continue taking obesity therapies not only to lose weight, but also to maintain that weight loss. Moving to a less frequent injection could be a positive. Second, this drug has a long half-life, which could result in better tolerability than competing products. Some people have estimated that obesity treatments could be a $100 billion market by the end of the decade, and potentially hundreds of billions over time. Even a 10% market share could add $10 to $20 billion to Amgen's revenue. And this is a stock trading at 15 times earnings, not with a price-earnings multiple in the high 30s or 40s. Investors' perceptions could change. There's a view that GLP-1 therapies have created winners and losers. MASH, or fatty liver disease, has been viewed as a loser. Companies have been trying to develop a therapy that could reverse the fibrosis of the liver for the past 20 years. Just 6 months ago, Madrigal Pharmaceuticals got the first ever approval for this indication. Barrons asks, what's the company's medication? Acker answers, Madrigal has a once-daily oral therapy. Those are generally well tolerated by patients. There's still a narrative that GLP-1 therapies are going to take over this market, meaning there wouldn't be a big opportunity for Madrigal, but we disagree. There are more than 10 million patients in the U.S. with MASH. The majority are undiagnosed. Consensus estimate put Madrigal's second quarter sales of its therapy at about $4 million. The company did $15 million. That could be a multi-billion-dollar opportunity. It's still underappreciated by the market. We invest in Vaxcyte back to 2020 when it was still private. Vaxcyte, or Vaxcyte, Vaxcyte, potentially has the best vaccine technology for pneumonia, a huge unmet need. Pneumonia causes 150,000 hospitalizations each year in the U.S., and it's one of the leading preventable causes of death for children under age 5 worldwide. There are different strains of the bacteria that cause pneumonia. The pneumonia vaccine market's been dominated by Pfizer, which makes Prevnar 20. Covering 20 strains. But as you add more strains, you lose effectiveness against existing strains, so it's been difficult to move beyond 20. Merck has a drug that covers 15 strains, but this is an unusual market in healthcare in that it's winner take all, or winner take most. The drug with the most coverage gets the majority of the market share, and Pfizer has 95% of the market. How many strains does Vaxcyte hope to cover, asks Barrons. Acker responds, Vaxcyte recently announced it has a vaccine that covers 31 strains. We think it could eventually become the dominant vaccine for pneumonia. Vaxcyte has a $14 billion market cap. My last name to offer is Vertex Pharmaceuticals. We've owned it since 2009 when it had a $4 billion market cap compared with $124 billion today. Vertex has great science and it's focused on transformational therapies for patients. It has the dominant treatment for cystic fibrosis, selling more than $10 billion a year in the U.S. The product has doubled overall patient survival from about 30 years to more than 60 years. The company is working on a number of other pipeline products that look exciting, including a non-opioid pain drug. We haven't had anything new for the treatment of pain in about 20 years. This non-opioid pain treatment will launch early next year if approved. It could be a large market opportunity. Consensus sales expectation is fairly low for next year at only around $100 million. Vertex's drug initially could be approved for acute pain treatment and over time for treatment of chronic pain. Other products in the pipeline also look exciting, including a potential cure for type 1 diabetes and several treatments for kidney disease. From Barrons, Jared, you're last, but hardly least. Holtz's response, Novo Nordisk is my first pick. I expect the company to have the first or second positioning in the biggest market in all of healthcare over the next 5 years, with more capital than any other company vying to get into or stay in the obesity market. Any competitive threat that exists, whether from Amgen or otherwise, can be thwarted by Novo at some point, either with less frequent injections, orals, or other means. I don't think that there is a significant market demand for a less frequent injection. From a behavioral psychology standpoint, it's easier for more patients, or most patients, to take a weekly shot than a monthly to better track their progress. Will investors, patients, and practitioners pay attention to the possibility of a monthly shot? Undoubtedly, because of interest in the category, but Novo can reformulate its therapy into a less frequent injection if it feels it needs to. Novo is trading for less than 25 times next year's expected earnings, which seems reasonable given the growth and profitability outlook and the fact that some medical device and life sciences companies are trading at a premium to Novo, with far less optimal growth prospects. Also, as we move into 2025, the premise that GLP-1s could work in treating Alzheimer's disease might be the biggest storyline in healthcare. If Novo and or Lilly are successful in that area, in that arena, their stocks could have another 50% upside at least. Barrons asks, what's behind the Alzheimer's premise? He responds, Holtz, these therapies appear to have dramatic anti-inflammatory properties that could impact neurodegeneration. Whether the impact is statistically significant in clinical trials is debatable, and it explains why there aren't tangible estimates yet regarding the impact on Novo and Lilly. Yet the drugs seem to have worked in addressing every other condition the companies sought to address, whether kidney disease or stroke or cardiac and metabolic conditions. Current Alzheimer's treatments are fairly ineffective, and they have bad side effects. My next pick is Humana, one of the worst performers in managed care year to date. Humana has underperformed because it acquired and has been growing its Medicare population concurrently with a pronounced spike in utilization. That's worst-case timing for a managed care company. Either Medicare utilization decelerates and earnings improve into next year, and the stock works on a fundamental basis, or there's a backstop. Cigna Group might be interested in acquiring the company should the stock get hit even more. Everything Cigna has said leads me to believe it's interested in acquiring a large, scalable Medicare business. That's why they're working on divesting their Medicare business this year. They might be waiting on the sidelines for greater clarity, which they might get under a Republican president. Whether Humana's fundamentals improve or Cigna comes in as a buyer, I expect the stock to be higher next year. Barrons says, well, how about a third idea? Holtz responds, I've been writing about Teva Pharmaceutical Industries for the past 9 months. It looks better than many large-cap pharma companies. Teva primarily makes generic drugs. This is a low-growth business. The company gains from other companies' patent expirations. About 15% of the business is high-margin, higher science neuropsychology products. That part's been growing nicely and has an underrated pipeline. Teva is trading close to distressed asset levels at roughly 6 times forward earnings. Yet there are large-cap pharma companies, including Bristol Myers and Pfizer, that arguably are in worse shape than Teva fundamentally, based on revenue and earnings growth concerns, driven by a combination of competitive entrants, loss of drug exclusivity, and drug pricing implementation through the end of the decade. Teva stock has at least 50% upside from here. Barrons asks, now that we've heard your stock picks, let's close with a look at November's election, in particular how the healthcare market might be affected by a change in administration. Jared, what's your view? Jared Holtz, I don't think we've heard anything that portends a wholesale change in healthcare policy. We're going to be operating within the confines of the Affordable Care Act for a while, which is good. The election outcome won't be binary for the healthcare sector. If the Democrats win, healthcare stocks will tread water, might perform better than that, given that the investor base understands the Democrats' policies a little better than the Republicans. In the event of a Republican victory, the tone could change in 2 ways. The mergers and acquisitions landscape could become more fluid and affable compared with the past 4 years. That won't benefit healthcare more than other sectors, but healthcare is a leader in consolidation. The biotech industry would be an obvious beneficiary, and given that 2 pharma companies are closing in on $1 trillion of enterprise value, and United Health is 6 times as big as most peers, we could set the stage for a merger of equals, which hasn't been discussed in this industry for years. Second, a Republican win likely will be viewed as better for Medicare Advantage reimbursement, which would be a positive for UNH, Humana, and such. From Graybosch, I agree that we could see more M&A in a Republican administration. Regulatory opposition to mergers has been a steady theme of the current administration and something clients often ask about. As for the Inflation Reduction Act and Obamacare, it's hard to predict whether a new administration will take a different stance. Both seem somewhat baked in for now. Acker said it matters not only who wins the presidency, but also whether we have one-party rule or a divided government. A divided government would make it a challenge to put through any significant changes to healthcare policy. And Kasdan said the ability for companies to consolidate is a natural function of our industry. It frees up capital that can be reinvested. It seems both presidential candidates are trending toward a change in the leadership of the FTC, which is good. The bigger issue, on which I'm sure Democrats and Republicans have become more aligned, is limiting China's role in U.S. drug development. Specifically, prior to this second Cold War, quote unquote, the answer to driving productivity in clinical development and running clinical trials faster and cheaper was to take them to China. Now, pressured rightly or wrongly by politicians, the FDA has basically shut the door on using China registrational data for approval. Shifting away from politics, we're in a wonderful magical moment in science and investing. Valuations in much of the healthcare sector have bottomed. The weakest players have been digested, and the pickings are better now. You have duration as an investor, measured not just in months or quarters or even years. This is a multi-year play. If that's the case, you could make double-digit returns in various subsectors, whether in managed care or biotech or large-cap pharma. You need to pick your spots carefully, but it is a magical moment for investors. What a magical note on which to end, says Barrons. Thanks, Eli and everyone. Editorial note, Josh Nathan Katzis contributed to this article. a correction or amplification. The comments regarding corporate leadership in healthcare were made by Eli Kasdan. An earlier version of the article incorrectly attributed them to Andy Acker. The comments regarding the 90-90 rule, a reference to the high percentage of both clinical failures and erroneous sales estimates for new drugs, were made by Acker. An earlier version attributed them to Jared Holtz. Fatty liver disease is known by the acronym MASH. An earlier version referred to it as NASH, the prior name of the condition. Very long, but hopefully very interesting article there on the healthcare opportunities. From the precious metals portion of Barrons this weekly, precious metals. Costco's gold bars are flying off the shelves. Demand is pushing the metal to record prices, by Ian Salisbury. Costco shoppers can't get enough of the discount chain's gold bars, despite, or perhaps because, gold keeps setting record prices. Costco Wholesale, mostly known for jumbo packs of paper towels, bite-sized food samples, and oversized slabs of salmon, started selling 1-ounce gold bars last fall. The move, which coincided with a bull market for gold, quickly proved a hit. Earlier this year, Wall Street analysts estimated Costco was hawking up to $200 million a month worth of gold. On Thursday, Costco executives confirmed consumers are still buying. In a conference call following the company's earnings, CFO Gary Millerchip said gold sales were up double digits in the quarter, along with other categories like jewelry, toys, and housewares. Costco sells the 24-karat gold bars exclusively to Costco members and only through its website. The price varies based on market conditions. The bars, which Costco sold for about $2,000 last fall, were priced at $2,699.99 on the retailer's website Friday, although they were listed as out of stock. The Costco price was about $48 above Friday's $2,652 spot price for gold, according to LSEG Workspace. In addition to markups when they buy, Costco gold shoppers have also faced hefty discounts when they try to sell their gold bars in order to cash out their investments. Gold has been one of the market's best performing assets in 2024, returning nearly 30% compared with about 21% for the S&P 500. The precious metal has benefited from a slew of factors, including declining interest rates and buying by central banks. Its spot price notched a fresh closing record on Thursday at $2,672.25, according to Dow Jones market data. One group that appeared to sit on the sidelines, surprising gold market analysts, was U.S. investors. While Costco clearly has a hit on its hands, demand has been slow to show up in a broader, more reliable gauge of retail investor sentiment: exchange-traded funds that own gold. Gold ETFs saw investors withdraw hundreds of millions of dollars a month through much of last year, even as the price of gold steadily climbed. Inflows were positive but subdued for most of 2024, picking up only since July, according to Morningstar data. Now that gold is in the headlines, regularly setting price records, U.S. ETF investors seem to be catching the gold bug. It all suggests that as long as the price of gold keeps rallying, Costco shoppers will keep buying. A retirement feature is next for the Barrons magazine of September 30th. The headline, "Seniors Shouldn't Worry About a Few Extra Pounds. Too Skinny's Not a Good Thing," by Neil Templin. Everybody knows that losing excess pounds lowers health risks, but the opposite may be true for many seniors. Numerous studies show that seniors who lose weight have higher mortality rates. This study, led by the University of California, San Diego, or UCSD, found that elderly women who maintained their weight lived longer than those who lost weight. The study of 18,200 participants published in Nature found that men who were mildly overweight had lower overall mortality rates than those who were normal weight according to their body mass index, or BMI. Doctors who treat elderly people take this into account. If an older patient comes in who's overweight or mildly obese and has no obesity-related issues, cardiologist Francisco Lopez Jimenez of the Mayo Clinic says he wouldn't prioritize weight loss. When you have a person who's 40, you don't know how obesity is going to weigh on that person's health in the next 30 or 40 years, Lopez Jimenez says. But if you have a 75-year-old with mild obesity who is metabolically healthy, including heart disease, and who's moving around well, do we have to waste resources trying to get that person to lose weight? Carl Levy, a cardiologist at Ochsner Health in New Orleans, wrote a book called The Obesity Paradox. It notes that obesity contributes to certain diseases, but heavier people of all ages often fare better than thin people once they're sick. This is particularly true of the elderly. Probably those with a little weight have more metabolic reserve to fight infections, cancers, and other diseases, Levy tells Barrons. Many have cardiovascular diseases, and numerous studies show an obesity paradox, where overweight and mildly obese patients with cardiovascular disease have a better prognosis than do the thin patients with the same heart disease. Why are Americans constantly being told to lose pounds to improve their weight and their health? It is good advice for the young and middle-aged. After all, excess weight can play a role in developing everything from heart disease to diabetes to certain cancers. But the advice shifts for seniors. As they age, they tend to gain fat and lose muscle. Retaining as much muscle as possible is important both for good metabolic health and for remaining mobile. It's part of the reason the CDC recommends resistance training twice a week. When people lose weight, meanwhile, they tend to lose both fat and muscle. That's usually not a problem for younger people, but it often is for older people who've already lost muscle mass. Those going on a diet can lessen the effects by doing resistance training, says Levy, the New Orleans cardiologist. Why is muscle mass so important? Muscles are critical for moving around and staying fit. Muscles also absorb sugar from the blood, and thus having bigger and stronger muscles can help prevent or control diabetes and other metabolic disorders. Muscle mass also plays a role in preventing and controlling heart disease, cardiologists say. Cardiologist Abdullah Damlouji of Johns Hopkins says multiple studies on heart disease, heart failure, and coronary artery disease have one thing in common. Whenever they take an older patient with lower skeletal body mass and compare them to someone with higher skeletal mass, they do far poorer in terms of rehospitalization rates, major cardiovascular disease events, and mortality. Some of the best health outcomes come for seniors with a BMI between 25 and 30, which usually means they're overweight but not actually obese, Damlouji says. They actually have lower mortality rates than normal weight seniors, he says. Does this mean normal weight seniors should try to gain weight for better health? Hardly. If you're thin, fit, and retain adequate muscle mass, there's no reason to change anything, doctors say. That said, you should avoid losing more weight. The obesity paradox underscores the problem with using BMI in the first place. BMI simply measures how heavy you are for a certain height. It does nothing to measure body composition. More muscular people who are in great shape can be classed as overweight, while couch potatoes with little muscle and a potbelly may show up as a normal weight. Since people tend to lose muscle and gain fat as they age, BMI can become an even more flawed measure for the elderly. Carrying fat also may have some use for seniors. Fat isn't normally protective, but can be an energy store for seniors who develop major medical problems, says Mayo's Lopez Jimenez. Imagine a person's very skinny and gets into a situation requiring intensive hospital care, and then they lose 30 to 40 pounds. The patient dies. They don't have enough energy reserves. Are diets always bad for seniors? No. If they have weight-related health issues such as diabetes, they should probably lose weight, doctors say. If they have a BMI of 35 or more, they should probably lose weight. But if you're a little overweight or even mildly obese and still in good health, you can relax. You'll likely do yourself some good, more good, by going on regular walks than by making a big push to lose just a few pounds. Geriatrician Luke Kim of the Cleveland Clinic ordinarily doesn't like his older patients to lose weight. I would just encourage them to stay where they are. He notes that many of the ailments he treats, including dementia, are often accompanied by weight loss. Thin people tend to have worse osteoporosis too. Too skinny is not a good thing, he says. And with that very good advice, and something that I'm happy to hear, being a few pounds overweight myself, we've come to the end of our reading of Barrons magazine for September 30th of 2024. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost. Bye for now.